Okay. Uh, June 20th, 2024 by Jennifer Marston. Title of the article is Financiers Can Close the Regenerative Agricultural Funding Gap and Unlock $4.5 trillion in the process. Article begins. Closing the current financing gap in regenerative agriculture would unlock $4.5 trillion in new investment opportunities per year and 5.7 trillion US dollars of cost per year saved in damages to people and the planet, according to a new report. This amounts to roughly 13 times and 16 times, respectively, in investment cost. How that financing gap gets closed depends on using the right financial instruments or sometimes a combination of multiple ones. The new report from investment firm Pollination and Transformational Investing in Food Systems, TIFS, a climate change investment and advisory firm, lays out what those are. From a financier's perspective, regenerative agriculture provides a way to maintain the commercial opportunity in agriculture via adaptation to changing climate conditions. Notes the report, which was produced with support from the Rockefeller Foundation. Quote, by investing in regenerative agriculture now, financiers can proactively adapt food and agricultural value chain investments to changing climate conditions and take advantage of potential opportunities in transition investing. The global financial sector has a tremendous opportunity to serve innovative farmers and companies with financial products that build regenerative agricultural systems, noted TIFS Director Rex Raimond, adding that the new report organizes the opportunities in the sector that are generating net positive financial and non-financial returns. Financial actors now have at their fingertips many viable pathways to utilize for regenerative agriculture investments, he said. Regenerative agriculture's financing gap not a problem of capital. Quote, the bankability gap in regenerative agriculture financing is the primary challenge preventing increased capital deployment, notes the report. Multiple studies estimate the global annual need for transition costs to be between 200 billion and 450 billion for at least the next decade. End quote. Funding flows right now are roughly 1/10 of estimated annual need. This systemic financing problem for regenerative agriculture can be boiled down to the simple fact that money isn't getting to farmers and producers able to implement changes, quote, to affect food system transformation at the speed and scale needed to combat climate change. End quote. The problem is not for lack of capital, however, as the report notes, quote, formal agricultural credit globally exceeds estimated needs for transaction costs, end quote. The report acknowledges there remain areas, typically emerging markets with smallholder farmers, that still lack adequate access to formal credit. Globally, formal agricultural credit is 1.1 trillion US dollars, and aggregate capital flowing to agriculture has experienced double-digit growth in the past decade. Rather, quote, the primary barrier to increasing capital deployment for regenerative agriculture is missing confidence that the financing will fit financiers' current risk and reward standards, end quote. Financing instruments with real potential for regenerative agriculture. Based on interviews with a variety of organizations, the report categorizes models for regenerative agriculture financing as either early model with growing traction or nascent model with potential. Where a financing instrument falls within those two structures is based on several factors, including its scalability, applicability across regions, financial risk profile, and where it falls on the market maturity curve. These are new loan products or established ones that have been revised to support regenerative agriculture and land use. Examples of regenerative operating loans include grace periods on repayment of loans, longer loan tenor up to 10 years, and discounted upfront fees for operating loans. In general, mainstream operating loan offerings are characterized by narrow use of proceeds, short tenors, and rarely incorporate sustainability-related adjustments in the cost of financing, notes the report. Mass adoption of regenerative practices begins with building a strong ecosystem of operating loan products that align financial terms with incentives for practice adoption. Climate risk-adjusted insurance. Farmers and producers rely on insurance to mitigate income volatility. So aligning insurance with risk assessments that include regenerative practices is an effective financing lever, according to the report. This might include building concessional terms into insurance policies that can go beyond the short policy periods associated with conventional crop insurance policies. A clear line can be drawn between regenerative production and long-run mitigation of agricultural risks, the report notes. Consequently, innovative insurers are beginning to take steps to incorporate climate and nature-related risk for agricultural production into premium pricing and additional period extensions for ESG and sustainability-aligned counterparties. Report authors highlighted that an unnamed insurer, the biggest insurer in a large emerging market, has already outlined plans to add climate and ESG risk-adjusted premiums for farmers, having already done a similar thing for the construction industry. Blended finance. Blended finance for regenerative agriculture involves strategically combining concessional funds, typically offered on a cheaper and more flexible terms than those available through the market, with private capital to finance regenerative projects, according to the report. The concessional funds, which usually come via development finance institutions, state-owned banks, philanthropists, and impact investors, serve to de-risk investments in regenerative agriculture by providing a cushion against potential losses. This makes projects more appealing to private investors. One such example is the $47 million the Responsible Commodities Facility Fund, which offers finance for deforestation-free soy production. The fund blends concessional impact capital and private capital to provide low interest rate financing for farmers supported by technical assistance. Another type of blended financing is found in farmland investment wherein generation of on-farm renewable energy, monetization of carbon credits, premiumization of sustainability-produced agriculture products, and integration of nature-based solution projects all present further opportunities for farmland investments to add sustainability-aligned revenue streams. The value of U.S. farmland held by investment funds has doubled from 2021 to more than $16 billion in 2023. As noted in the report, regenerative agriculture provides a strong value proposition to unlock both the core commercial value of farmland and the additional potential value derived from sustainability initiatives. Nascent models with potential. Newer financing models are also emerging in regenerative agriculture. These include private equity and vertical integration approaches, which bring together input procurement, regenerative production, carbon credits, and many other parts of the entire agricultural value chain. In short, these provide midstream and downstream incentives, capacity, and scale to promote regenerative production upstream. Also, regenerative project finance, which lets large-scale regenerative agriculture products receive capital at the beginning of the project lifecycle based on long-term commercial viability. Debt and equity are repaid with cash flow generated by the project's commodity or environmental market, for example, carbon credits and revenues. Report authors emphasize that regenerative agriculture is still just a promising, dynamic, and burgeoning field, and that all financing for it is a nascent area. The degree of nascency cannot be overstated, end quote. It highlights a number of investors already making strides in the area, including 12 Tree, Agri3, Agricultural Capital, Impact Ag Partners, and SLM Partners. End of article. So most interesting from this article would be that the value of U.S. farmland held by investment funds has doubled since 2021 to being more than $16 billion as of 2023. And it says regenerative agriculture provides a strong value proposition to unlock both the core commercial value of farmland and the additional potential value derived from sustainability initiatives. So in summary, interesting article. Very interesting to see that both Pollination and Transformational Investing in Food Systems, TIFS, contributed to this report, in addition to some support from the Rockefeller Foundation. And then really exciting to see at the bottom of the article a list of some firms. It says investors here: 12 Tree, Agri3, Agriculture Impact, Impact Ag Partners, and SLM Partners, all contributing and dipping their toes into this industry. So yeah, sky's the limit. And it says a burgeoning field, I guess pun intended. But there's a lot left to be. So this is really the problem with nascent areas, is that nobody wants to be the first one to jump into the pool. And unless there is a philanthropic or a true sort of play money slush fund element, a lot of these investors or funds or even private equity plays are obliged to actually generate some type of yield or profit at the close of the fund, or to redistribute funds to the investors. Certainly not at a loss would be the goal, unless it's a philanthropic endeavor and they can just have what they will. Um, so yeah, but for me, it's that one statistic about the value of U.S. farmland held by investment funds has doubled since 2021 to more than 16 billion 2023 is really what needs to be known is that there's a lot of financial movement, and this is where the money is going to be. This is where the money is going to continue to go, and it's going to be very interesting to see how more firms, in addition to the ones listed in this article, will also attempt to enter the industry, because it's a little bit of a blue ocean strategy. Certainly, a lot of room to coexist, and there's a lot of room to play with, and you just sort of need a market expertise. So, assuming that the ones listed in this article are leaders and they have a proof of concept, they have an MVP, a minimal viable product, if you will, for their funds or their investments and case studies, then you can certainly see that a trickle will turn into a deluge of other companies that want to sort of copy and paste the business model once it's been proven that it is a successful endeavor. So that's what the article stresses several times, and we concur. So great article, very interesting, very informative across the spectrum of investors.